National Test 7, Finance 7.1, b. A state in which a mortgagee has equitable title to a secured property. States differ in their interpretation of who owns mortgaged property. Those that regard the mortgage as a lien held by the mortgagee, lender, against the property owned by the mortgager, borrower, are called lien theory states. Those that regard the mortgage document as a conveyance of ownership from the mortgager to the mortgagee are called title theory states. 7.2 d. It is evidence of the borrower's debt to the lender. A valid mortgage or trust deed financing arrangement requires a note as evidence of the debt. 7.3 a. Trust deed or mortgage. The mortgage or trust deed is evidence of the collateral pledge of the purchased property as security for the loan. 7.4 b. Mortgager. The mortgager is the borrower and the mortgagee is the lender. As a memory aid, notice that lender and mortgagee both have two ES. Mortgager and borrower both have two OS. 7.5 d. $1,000. Multiply the rate times the loan amount and divide by 12 to calculate monthly interest. Thus, $200,000 x 6%, divided by 12 equals $1,000. 7.6 b. $100,000. The equation for the loan amount is, annual interest divided by the interest rate, equals loan amount. Thus, $500 x 12, divided by 0.06 equals $100,000. 7.7 a. 7.5%. The equation for the interest rate is, annual payment / loan amount, equals interest rate. Thus, $3,750 / $50,000, equals 7.5%. 7.8 b. $2,000. A discount point is 1% of the loan amount. Thus, 1 point on a $100,000 loan equals $100,000 x 2%, or $100,000 x 0.02, or $2,000. 7.9 b. Part of each periodic payment is applied to repayment of the loan balance in advance and part is applied to payment of interest in arrears. In an amortizing loan, part of the principal is repaid periodically along with interest, so that the principal balance decreases over the life of the loan. The annual interest is never the same, since the principal balance to which the interest rate applies changes every year. Interest on a loan is always paid in arrears, not in advance. 7.10 b. Private mortgage insurance. Mortgage insurance protects the lender against loss of a portion of the loan, typically 20 to 25%, in case of borrower default. Private mortgage insurance generally applies to loans that are not backed by the Federal Housing Administration, FHA, or Veterans Administration, VA, and that have a down payment of less than 20% of the property value. The FHA has its own insurance requirement for loans with a down payment of less than 20%. 7.11 d. The fraction of the appraised value of the property offered as collateral which the lender is willing to lend. the relationship of the loan amount to the property value, expressed as a percentage, is called the loan-to-value ratio, or LTV. If the lender's loan-to-value ratio is 80%, the lender will lend only $80,000 on a home appraised at $100,000. The difference between what the lender will lend and what the borrower must pay for the property is the amount the borrower must provide in cash as a down payment. 7.12 C. Buyer's down payment. Price less loan is the down payment. This is also the buyer's initial equity. 7.13 A. Refusing a loan because the borrower does not match the lender's target market. The Equal Credit Opportunity Act, ECOA, requires a lender to evaluate a loan applicant on the basis of that applicant's own income and credit rating, unless the applicant requests the inclusion of another's income and credit rating in the application. In addition, ECOA has prohibited a number of practices in mortgage loan underwriting, including refusing a loan based on an applicant's demographic characteristics. 7.14 B. $1,680. Monthly income qualification is derived by multiplying monthly income by the income ratio. Thus, 72,000/12 x.28 equals $1,680. Remember to first derive the monthly income. 7.15 B. Adjust the applicant's debt ratio calculation and lower the loan amount. Since a lender lends only part of the purchase price of a property according to the lender's loan-to-value ratio, a lender will verify that a borrower has the cash resources to make the required down payment. If someone is lending an applicant a portion of the down payment with a provision for repayment, a lender will consider this another debt obligation and adjust the debt ratio accordingly. This can lower the amount a lender is willing to lend. 7.16 C. All loans secured by a residence. Regulation Z applies to all loans secured by a residence. It does not apply to commercial loans or to agricultural loans over $25,000. Its provisions cover the disclosure of costs, the right to rescind the credit transaction, advertising credit offers, and penalties for non-compliance with the Act. 7.17 D. The borrower has a limited right to cancel the transaction within a certain period. A borrower has a limited right to cancel the credit transaction, usually within 3 days of completion of the transaction. The right of rescission does not apply to residential mortgage transactions, that is, to mortgage loans used to finance the purchase or construction of the borrower's primary residence. It does, however, apply to refinancing of mortgage loans, and to home equity loans. State law may require a rescission period and notice on first mortgage loan transactions as well. 7.18 B. Ask the buyer/borrower about his/her religion or national origin. ECOA prohibits discrimination in extending credit based on race, color, religion, national origin, sex, marital status, age, or dependency upon public assistance. A creditor may not make any statements to discourage an applicant on the basis of such discrimination or ask any questions of an applicant concerning these discriminatory items. A real estate licensee who assists a seller in qualifying a potential buyer may fall within the reach of this prohibition. 7.19 d. Not FHA insured or VA guaranteed. A conventional mortgage loan is a permanent long-term loan that is not FHA insured or VA guaranteed. FNMA does not back loans, FHA only insures FHA loans, and the VA, not GNMA, guarantees loans. 7.20 b. Limited by when the loan was originated. Rules for assumability vary according to when the FHA-insured loan was originated and whether the original loan was for an investment property or an owner-occupied principal residence. Loans originated before December 1, 1986, are generally assumable without restriction. Loans originated after December 1, 1986, require that the assumer show creditworthiness. Some mortgages executed from 1986 through 1989 contain language that is not enforced as a result of later congressional action. Mortgages from that period are now freely assumable, despite any restrictions stated in the mortgage. 7.21 c. How much of a loan the VA will guarantee. A veteran must apply for a certificate of eligibility to find out how much the VA will guarantee in a particular situation. 7.22 d. 0. If a loan is fully amortizing, its loan balance is 0 at the end of the loan term. 7.23 b. The buyer gives the seller a mortgage and note as part of the purchase price of the property. With a purchase money mortgage, the borrower gives a mortgage and note to the seller to finance some or all of the purchase price of the property. The seller in this case is said to take back a note, or to carry paper, on the property. 7.24 c. Hypothecation. The process of securing a loan by pledging a property without giving up ownership of the property is called hypothecation. 7.25 a. The borrower gives the lender a note and a mortgage in exchange for loan funds. When a borrower gives a note promising to repay the borrowed money and executes a mortgage on the real estate for which the money is being borrowed as security, the financing method is called mortgage financing. 7.26 c. The trustor conveys title to a trustee in exchange for loan funds from the beneficiary. A deed of trust conveys title to the property in question from the borrower, trustor, to a trustee as security for the loan. The trustee is a third-party fiduciary to the trust. While the loan is in place, the trustee holds the title on behalf of the lender, who is the beneficiary of the trust. 7.27 a. Title theory state. States that regard the mortgage document as a conveyance of ownership from the mortgagor to the mortgagee are called title theory states. 7.28 b. Usury. Many states have laws against usury, which is the charging of excessive interest rates on loans. Such states have a maximum rate that is either a flat rate or a variable rate tied to an index such as the prime lending rate. 7.29 c. $1,200. A point is 1 percentage point of a loan amount. Thus, 2 points on a $60,000 loan equal 0.02 x $60,000, or $1,200. 7.30. A. An amortized loan is paid off over the loan period. Amortized loans retire the principal balance over the loan period. If a loan does not do this, one must make a balloon payment at the end of the loan term to complete the loan payoff. 7.31. C. It is a negotiable instrument. A promissory note is a negotiable instrument, which means the payee may assign it to a third party. The assignee would then have the right to receive the borrower's periodic payments. 7.32. D. May be required to execute a release of mortgage document. Lenders may be required to release the mortgage or trust document to the borrower when the borrower has paid off the loan and all other sums secured by the document. The release clause, also known as a defeasance clause, may specify that the mortgagee will execute a satisfaction of mortgage, also known as release of mortgage and mortgage discharge, to the mortgagor. 7.33. A. An appraisal report. Loan underwriting is the process of assessing the lender's risk in giving a loan. Mortgage underwriting includes evaluating the borrower's ability to repay the loan, appraising the value of the property offered as security, and determining the terms of the loan. 7.34. C. The ability to repay, the value of the collateral, and the profitability of the loan. A lender assesses risks by examining, or qualifying, both borrower and property. In qualifying a borrower, an underwriter weighs the ability of the borrower to repay the loan. In qualifying a property, an underwriter assesses the ability of the property value to cover potential losses. In this evaluation, a lender requires that the appraised value of the property be more than adequate to cover the contemplated loan and costs. Finally, the loan must make money for the lending organization as a basic business precept. 7.35. B. They want to ensure there is more than enough collateral to cover the loan amount. Without an ample difference between the property value and the loan amount, a drop in property values could cause the loan balance to exceed the collateral itself. This greatly increases the risk of a loan loss should the borrower default, since the balance could not be completely recovered in a foreclosure sale. 7.36. B. Consider the income of a spouse in evaluating a family's creditworthiness. The Equal Credit Opportunity Act, ECOA, requires a lender to evaluate a loan applicant on the basis of that applicant's own income and credit rating, unless the applicant requests the inclusion of another's income and credit rating in the application. In such a case, a lender may not discount or disregard income from part-time work, a spouse, child support, alimony, or separate maintenance. 7.37. A. Ensure the buyer has the earning power to make the loan payments. Both the income and debt ratios in borrower qualification quantify how much a borrower can safely afford to pay on a mortgage loan. The income ratio focuses on the borrower's earning power. 7.38. D. Debt payments divided by gross income. The debt ratio formula is debt obligations divided by income. 7.39. C. The parties complete all loan origination documents and the loan is funded. Closing of a mortgage loan normally occurs with the closing of the real estate transaction. At the real estate closing, the lender typically has deposited the funded amount with an escrow agent, along with instructions for dispersing the funds. The borrower deposits necessary funds with the escrow agent, executes final documents, and receives signed copies of all relevant documents. 7.40 B. Truth in Lending Laws and Regulations. Regulation Z, which implements the Truth in Lending Act, applies to all loans secured by a residence. It does not apply to commercial loans or to agricultural loans over $25,000. It prescribes requirements to lenders regarding the disclosure of costs, the right to rescind the credit transaction, advertising credit offers, and penalties for non-compliance with the Truth in Lending Act. 7.41 A. The Equal Credit Opportunity Act. ECOA prohibits discrimination in extending credit based on race, color, religion, national origin, sex, marital status, age, or dependency upon public assistance. 7.42 C. The Real Estate Settlement and Procedures Act. RESPA is a federal law which aims to standardize settlement practices and ensure that buyers understand settlement costs. RESPA applies to purchases of residential real estate, 1 to 4 family homes, to be financed by federally related first mortgage loans. In addition to imposing settlement procedures, RESPA provisions prohibit lenders from paying kickbacks and unearned fees to parties who may have helped the lender obtain the borrower's business. 7.43 B. Buying securities, changing the discount rate, and controlling banking reserves. The Federal Reserve System regulates the money supply by means of 3 methods: selling or repurchasing government securities, primarily Treasury bills, changing the reserve requirement for member banks, changing the interest rate, or discount rate. The system charges member institutions for borrowing funds from the Federal Reserve System. 7.44 A. It cycles funds back to primary lenders so they can make more loans. Secondary mortgage market organizations buy pools of mortgages from primary lenders and sell securities backed by these pooled mortgages to investors. By purchasing loans from primary lenders, the secondary market returns funds to the primary lenders, thereby enabling the primary lender to originate more mortgage loans. 7.45 A. Fannie Mae, Freddie Mac, and Ginnie Mae. As major players in the secondary market, the Federal National Mortgage Association, FNMA, Fannie Mae, Government National Mortgage Association, GNMA, Ginnie Mae, and Federal Home Loan Mortgage Corporation, FHLMC, Freddie Mac, tend to set the standards for the primary market. FHA, VA, and the Federal Reserve are not organizations in the secondary mortgage market. 7.46 C. It purchases FHA-backed and VA-backed loans. Fannie Mae buys conventional, FHA-backed, and VA-backed loans, gives banks mortgage-backed securities in exchange for blocks of mortgages, and sells bonds and mortgage-backed securities. It does not guarantee, insure, or originate loans. 7.47 B. it insures loans made by approved lenders. The Federal Housing Administration, FHA, does not lend money, but insures permanent long-term loans made by others. The lender must be approved by the FHA, and the borrower must meet certain FHA qualifications. 7.48a. It guarantees loans made by approved lenders. The Veterans Administration, VA, offers loan guarantees to qualified veterans. The VA partially guarantees permanent long-term loans originated by VA-approved lenders on properties that meet VA standards. The VA's guarantee enables lenders to issue loans with higher loan-to-value ratios than would otherwise be possible. 7.49c. The loan payments gradually increase. Graduated payment mortgages allow for smaller initial monthly payments which gradually increase. The interest rate remains fixed, as does the loan term. 7.50b. The borrower pays additional interest at the onset in order to obtain a lower interest rate. A buy-down loan entails a prepayment of interest on a loan. The prepayment effectively lowers the interest rate and the periodic payments for the borrower. Buy-downs typically occur in a circumstance where a builder wants to market a new development to a buyer who cannot quite qualify for the necessary loan at market rates. National Test 8, Investments, Taxation, Ethics 8.1, b. Negative leverage. Leveraging is borrowing funds in order to make an investment that is larger than your own resource permits you to do directly. In negative leverage situations, your cost of borrowing funds to make the investment becomes greater than the income the investment returns to you. 8.2, b. Income properties. Cost recovery, or depreciation, allows the owner of income property to deduct a portion of the property's value from gross income each year over the life of the asset. Principal residences cannot be depreciated, unless portions are treated as a home office. Further, land cannot be depreciated. 8.3, c. 19.5%. Appreciation amount is the current value of the property minus the original cost. The total appreciation rate is derived by dividing the appreciation amount by the original cost. Subtract the estimated current market value from the price originally paid, $239,000 to $200,000 equals $39,000, and then divide the result by the original price, $39,000/$200,000 equals 195 or 19.5%. 8.4, d. A deduction for mortgage interest. Deducting mortgage interest is a significant tax advantage of owning one's residence. Depreciation and cost deductions do not apply to a non-income producing residence. Appreciation is a benefit, but not a tax benefit. 8.5, d. $232,900. The figure for net proceeds from sale is expressed by the formula, sale price, costs of sale equals net proceeds. Thus $250,000, 6% x $250,000, 600 to 1,500 equals $232,900. 8.6, b. $157,000. The beginning basis is the cost of acquiring a property. Basis is increased by capital improvements and decreased by depreciation. The basic formula for adjusted basis is beginning basis, $150,000, plus capital improvements, $3,000 plus $4,000, depreciation, $0, equals adjusted basis, $157,000. 8.7, C, $34,000. The gain on sale, capital gain, of a primary residence is represented by the basic formula, amount realized, net sales proceeds, $210,000, adjusted basis, $176,000, equals gain on sale, $34,000. Note the purchase price of the second house is irrelevant. 8.8, A. There is no taxable gain. There is no taxable gain because the gain falls under the exclusion limit of $250,000. As of August 5, 1997, tax law provides an exclusion of $250,000 for an individual taxpayer and $500,000 for married taxpayers filing jointly on the gain from sale of a principal residence. The seller must have owned the property for at least 2 years during the 5 years preceding the date of sale, used the property as principal residence for a total of 2 years during that 5-year period, and have waited 2 years since the last use of the exclusion for any sale. 8.9, C. Direct investment. Individuals, corporations, or other investor entities may invest as active investors in a property by buying it directly and taking responsibility for managing and operating the property. This investment mode is called direct investment. 8.10, A. $2,100. Annual gross operating income, $1,500 x 12 equals $18,000, annual operating expenses, $500 x 12 equals $6,000, equals annual net operating income, $12,000, annual net operating income, $12,000, cost recovery expense, $5,000, equals taxable income, $7,000, taxable income, $7,000, x tax rate, 30%, equals tax liability, $2,100. 8.11, B. The more the investor stands to gain, the greater the risk that the investor may lose. The general rule in investments is that the safer the investment, the more slowly it gains in value. The more you want it to gain, and the more quickly, the more you must risk losing it. Reward in investing corresponds directly to the degree of risk. 8.12, A. Income and tax benefits. The basic financial rewards of an investment include income, appreciation in asset value, positive borrowing leverage, and tax benefits. 8.13, D. Relatively illiquid. Real estate is by nature more difficult to convert to cash than many other types of investment. Compare the selling of a home with the ease of drawing money out of a bank account or selling a stock. 8.14, B. a more management-intensive investment. Real estate tends to require a high degree of investor involvement in management of the investment. Even raw land requires some degree of maintenance to preserve its value. Improved properties often require extensive management, including repairs, maintenance, on-site leasing, tenant relations, security, and fiscal management. 8.15 A. A general partnership. A general partnership is a syndicate in which all members participate equally in managing the investment and in the profits or losses it generates. 8.16 D. Gross income minus expenses minus building depreciation. Taxable income from investment real estate is the gross income received minus any expenses, deductions, or exclusions that current tax law allows. Depreciation of land is not allowed. 8.17 C. Deduct interest payments from income. Taxable income is net operating income minus all allowable deductions. The interest portion of debt service is allowed and is deducted from net operating income as interest expense. Principal repayment is not an allowable deduction on investment properties. Capital gain derivation does not involve interest or principal payments. 8.18 D. The owner may be able to avoid capital gain tax when the property is sold, provided the owner meets certain ownership and use tests. There is no capital gain tax on sale of the property unless the gain exceeds $250,000 for a single taxpayer or $500,000 for married taxpayers who file jointly. Since the property is not used for business, deductions for expenses against income are not allowed. 8.19 C. May be deducted from the sale price for gains tax purposes. Selling costs include such expenses as brokerage commissions, relevant advertising, legal fees, seller paid points and other closing costs. These costs are deducted from the selling price to get the amount realized, which is reduced by the adjusted basis to calculate gain on sale for gains tax purposes. 8.20 B. The difference between amount realized and adjusted basis. The formula for gain tax is taxable gain on sale x the owner's marginal tax bracket. The formula for gain on sale is amount realized, adjusted basis equals gain on sale. The formula for amount realized is selling price, selling costs equals amount realized. Therefore, the gain tax equals amount realized, adjusted basis, x tax rate. 8.21 C. A tax district. Real estate property taxes are imposed by taxing entities or taxing districts at county and local levels of government. States may legally levy taxes on real property, but most delegate this power to counties, cities, townships, and local taxing districts. The federal government does, however, tax income derived from real property and gains realized on the sale of real property. 8.22 B. Properties owned by a government agency. Certain types of property are exempt from property taxes. Certain classes of property owner may also be exempted or have a reduced liability. Exemptions include government-owned properties, real properties owned by churches, and properties owned by other nonprofit organizations. 8.23 c. It adjusts assessments in a locality to make them more consistent with an average level for the state or other higher level jurisdiction. Equalization factors level out the unevenness of valuations for groups of properties. For instance, if assessed values of properties in one county are consistently 10% below the average for other counties, an equalization board may multiply each assessed value in that county by a factor of 110% to raise them to the average level for the state. 8.24 c. $2 billion. The mill rate equals tax requirement / the tax base. A mill is 1/1000th of a dollar, $0.001. To solve for the tax base, reconfigure this formula to be base equals tax requirement / mill rate. Thus the base equals $20 million / $0.010, or $2 billion. 8.25 d. $441. The library tax is $1 x 147, and the fire district tax is $2 x 147. Thus the tax is $441. 8.26 b. $5,700. Special assessments are based on the cost of the improvement and apportioned on a pro rata basis among benefiting properties according to the value that each parcel will receive from the improvement. Here, Mary's share is 38/200, or 19%. 19% x $30,000 equals $5,700. 8.27 a. A conveyance instrument for a property that is sold to enforce a tax lien. A tax deed is a legal instrument for conveying title when a property is sold for non-payment of taxes. The application for a tax deed causes the taxing agency to institute a tax sale or tax foreclosure. 8.28 d. A statutory right of redemption. If the taxpayer can redeem the property after the tax sale, this right is known as a statutory right of redemption. In this case, the taxpayer must pay the amount paid by the winning bidder at the tax sale, plus any charges, additional taxes, or interest that may have accumulated. 8.29 b. The total of all assessed values of properties minus exemptions. The tax base of an area is the total of the appraised or assessed values of all real property within the area's boundaries, excluding partially or totally exempt properties such as those owned by the government or nonprofit organizations. 8.30 c. Multiplying each district's tax rate times the taxable value of the property. Each property owner's tax bill is determined by multiplying the tax rate for each taxing district times the taxable value of the property. Taxable value is the assessed value after all exemptions and adjustments have been taken into account. 8.31 a. Civil Rights Act of 1866. The original Fair Housing Statute, the Civil Rights Act of 1866, prohibits discrimination in housing based on race. The prohibition relates to selling, renting, inheriting, and conveying real estate. 8.32 c. Race, color, religion, and national origin. Title 8 of the Civil Rights Act of 1968, known today as the Fair Housing Act, prohibits discrimination in housing based on race, color, religion, or national origin. 8.33 c. Advertising a property as available to individuals of a particular race. The prohibition against discriminatory advertising states that an agent may not advertise residential properties in such a way as to restrict their availability to any prospective buyer or tenant. 8.34 c. An agent persuades a family to put their house on the market because ethnic minority families are beginning to move into the neighborhood. Blockbusting, a prohibited activity, is the practice of inducing owners in an area to sell or rent to avoid an impending change in the ethnic or social makeup of the neighborhood that will cause values to go down. 8.35 a. The Home Mortgage Disclosure Act. The Home Mortgage Disclosure Act requires lenders involved with federally guaranteed or insured loans to exercise impartiality and non-discrimination in the geographical distribution of their loan portfolio. In other words, the Act is designed to prohibit redlining, the practice of restricting loans by geographical R.A. 8.36 c. Privately owned single-family residences listed with a broker. Among the circumstances where the Fair Housing Act might allow for an exemption is a privately owned single-family home where no broker is used, with certain additional conditions. In other words, as soon as a broker is used in the sale, the law applies. 8.37 a. Illegal, because the agent changed the terms of the sale to discourage this particular couple. The Fair Housing Act prohibition against discriminatory misrepresentation states that an agent may not conceal available properties, represent that they are not for sale or rent, or change the sale terms for the purpose of discriminating. 8.38 d. The owner of a duplex who resides in one of the units refuses to rent the other unit to a non-Christian. The Fair Housing Act would exempt the owner in this situation because it involves rental of an apartment in a 1 to 4 unit building where the owner is also an occupant and there is no discriminatory advertising. 8.39 b. File a complaint with HUD or file suit against the offending parties in a state or federal court within the prescribed time period. The Fair Housing Amendments Act of 1988 prohibits discrimination based on sex. If May feels she has been discriminated against in this way, she may file a complaint with the Office of Fair Housing and Equal Opportunity, OFHEO, in HUD within 1 year or file suit in a federal or state court within 2 years of the alleged violation. 8.40 a. Inform Scott that the condition is illegal and that she cannot comply with it. Scott is not allowed to discriminate based on race, color, religion, national origin, sex, family status, or handicap. If an agent goes along with a client's discriminatory act, the agent is equally liable for violation of fair housing laws. It is thus imperative to avoid complicity with client discrimination. Further, an agent should withdraw from any relationship where client discrimination occurs. 8.41 c. Require families without children to pay the same security deposit that families with children must pay. Fair housing laws prohibit discriminatory advertising, discrimination on the basis of national origin, discrimination based on age in dwellings of more than 4 units, and discrimination against families with children. The fact that the owner is requiring the same deposit from tenants with and without children does not discriminate against families with children but actually favors them. 8.42 d. It is a single-family house, and the owner owns only one other rental home in addition to his own residence. Federal fair housing laws do not prohibit age and family status discrimination in residential dwellings of 4 units or less and in single-family houses if sold or rented by owners who have no more than 3 houses. 8.43 c. The Fair Housing Amendments Act of 1988. The Fair Housing Amendments Act of 1988 prohibited discrimination based on sex and discrimination against handicapped persons and families with children. Executive Order 11063 concerned racial discrimination in housing where federal funding was involved. The Civil Rights Act of 1968 concerned discrimination based on race, color, religion, and national origin. Jones v. Meyer concerned racial discrimination. 8.44 c. Steering. Steering is the illegal practice of limiting customers' choices by encouraging or discouraging them about the suitability of an area and directing them only to areas the agent deems suitable for them. 8.45 a. Providing unequal services. The agent may be illegally providing unequal services by altering the nature or quality of brokerage services to a party based on race, color, sex, national origin, or religion. 8.46 a. Discriminatory misrepresentation by omission. Discriminatory misrepresentation is the concealing of available properties, representing that they are not for sale or rent, or changing the sale terms for the purpose of discriminating. National Test 9, Closings, Risk Management, Property Management 9.1, c. Returns funds to the buyer. If for any reason the transaction cannot be completed, the escrow instructions usually provide a mechanism for reconveying title to the seller and funds to the buyer. In such a case, both parties return to their original status as if no sale had occurred. 9.2 d. Disclose in writing any business relationships they have with other parties involved in the transaction. Business relationships and affiliations among real estate firms, mortgage brokers, title insurance firms and other such companies that are involved in a transaction are permitted, provided the relationships are disclosed in writing to the consumer. The consumer is free to go elsewhere for the relevant service, and the companies do not exchange fees for referrals. 9.3 a. The item must be prorated and recorded as a debit to one party and a credit to the other party for the same amount. An income or expense item that affects both parties is apportioned, or prorated, to each party to reflect the proper amount that each owes or should receive. A prorated item is treated as a debit to one party and a credit to the other party for the same amount. 9.4 b. At some time after the expense is incurred. Items paid in arrears are paid after the expense has been incurred. 9.5 d. a debit to the seller and credit to the buyer for $580. For income the seller received in advance, the buyer receives a credit and the seller receives a debit. In effect, the seller has received some of the buyer's income, and the seller must pay this share to the buyer. Therefore the seller is debited and the buyer is credited the $580 the buyer is entitled to earn as the new owner. 9.6. B. A debit to the seller and credit to the buyer for $43. For an item the buyer will pay in arrears, the buyer receives a credit and the seller receives a debit. In effect, the seller has incurred some of the expenses that the buyer will be paying for after closing. Thus the seller must pay the buyer the used portion of the expense, or $43. 9.7. B. $546. The daily tax expense, first, is $2,190 divided by 365, or $6. Since the buyer will pay the taxes after closing, the seller will owe the buyer his or her portion of the tax bill, which is the 91 days from the beginning of the year through closing. Therefore, credit the buyer and debit the seller, $6 x 91, or $546. 9.8. D. $191.67. This method assumes all months are 30 days and the year is 360 days. The daily proration is therefore $375 divided by 360, or $1.04. The closing occurs on the 184th day of the year. Thus, $1.04 x 184 equals $191.67. Note that if the day of closing is the buyer's, there would be 183 days worth of prorated expense. 9.9. D. $735.34. Assuming a 365-day year, the daily tax expense is $1,100 divided by 365, or $3.013. As taxes are paid in arrears, the buyer will be paying the annual bill. Thus, he will be owed a credit for the seller's share of the bill, which is $3.013 x 244 days, or $735.34. 9.10. A. $116.03. The buyer's share is the unused portion, or 365 days, 244 days, or 121 days. The daily expense is $350 divided by 365, or $0.9589. $0.9589 x 121 equals $116.03. The seller receives this amount as a credit and the buyer a debit. 9.11. A. $507.50. If the buyer pays $525 interest for 30 days, the daily expense is $525 divided by 30, or $17.50. If there are 29 days of prepaid expense, the buyer's charge is $17.50 x 29, or $507.50. 9.12, c. $1,775. $88,750 x .02 equals $1,775. Remember, 1 point equals 1% of the loan amount. 9.13, d. $11,250. $187,500 x 6% equals $187,500 x .06 equals $11,250. 9.14, d. The buyer must pay the expense. Explicit agreements in the sale contract supersede traditional expense payment responsibilities, which can vary from state to state. 9.15, a. The excess of the buyer's debits over the buyer's credits. To determine how much money the buyer owes at closing, the buyer's debits are totaled and compared with the total of the buyer's credits. The excess of debits over credits is the amount the buyer must bring to the closing. 9.16, d. Negligence, error, or omission in carrying out professional services. A standard E&O policy provides coverage for damages resulting from any negligent act, error, or omission arising out of professional services. It does not cover dishonest or illegal acts, including environmental violations and mishandling of funds. 9.17, a. Failing to inform and disclose properly. Agency risks commonly concern the requirement to inform and disclose. Most states require agency relationships to be in writing and to be disclosed to all parties to a transaction. In states that do not use agency, there is still the obligation to explain and disclose the nature of the relationship. 9.18, b. Failing to disclose known adverse facts. Depending on the state, the licensee may have no further duty to disclose property condition after properly informing parties of their rights and obligations. However, the licensee may still be subject to legal action for failing to disclose adverse facts the licensee knew about or should have known about. 9.19, d. Avoid creating a false impression that the licensee is a certified appraiser. Misuse of such terms as appraisal and value could lead to a charge of misrepresenting oneself as an appraiser. 9.20, b. Exceeding the authority of the agreement. Licensees must stay within the bounds of the authority granted by the agency agreement and avoid doing anything requiring permission without first getting that permission in writing. 9.21, a. Use a checklist of all items, contingencies, dates, and responsibilities that must be met. One way to reduce risk in the contracting process is to use a checklist that covers all the contract items, such as inclusions and exclusions, contingency periods, documents, forms, data checking, and milestone dates. 9.22, d. The principals may make changes as long as they sign or initial each change. Real estate professionals who are not attorneys are usually limited to filling in blanks or making deletions on a pre-printed contract form prepared by a lawyer. While a licensee may make deletions, additions to a form should be drafted by an attorney. The principals themselves can make changes as long as each change is signed or initialed by all signers. 9.23 b. Obtain education in the content and intent of the laws. The risk of violating fair housing laws can be minimized through ongoing education that addresses both the intent of the laws and their current content. 9.24 a. Being present at a conversation where the setting of commission rates is discussed. Antitrust laws forbid brokers to band together to set a price on their services in listing and selling property. Even being overheard discussing commission rates or being present at such a conversation can lead to charges of price fixing. 9.25 a. License discipline, fines, and possible incarceration. Intentional misrepresentation, as a type of fraud, is a criminal act that may result in fines and incarceration, in addition to discipline from state regulators and professional organizations. 9.26 c. Stating that a client should seek legal counsel. Unintentional misrepresentation occurs when a licensee unknowingly gives a consumer inaccurate information concerning a property, financing, or agency service. Information that the licensee, as a professional, should have known to be false or inaccurate may be included in the definition. Telling a client that legal counsel would be advisable is not misrepresentation and, in fact, is often an important risk management technique. 9.27 d. Avoid speculative statements in all reports. Progress reports should be accurate, timely, in writing, and free of speculation. Speculation may encourage the consumer to believe the agent has expertise that in fact is non-existent. If a consumer has a question about the meaning of something in an inspection report, the licensee should refer the consumer to the person who wrote the report rather than trying to explain it. 9.28 b. It reduces the chance of presenting an offer from an unqualified buyer. Using a lender to qualify the buyer protects the agent against leading a seller to believe a purchaser is fully qualified when this may not be the case. Also, lenders and loan agents are better able to look into the buyer's qualifications than a real estate licensee is. If it is necessary to show a property to a potential buyer who has not been qualified by a lender, the licensee can gain some protection by performing an informal qualification and documenting the fact that it was based on the information provided by the buyer. 9.29 c. The agency relationship. Maintaining the confidentiality of any information that would harm the client's interests or bargaining position or anything else the client wishes to keep secret, unless the law requires disclosure, is one of the primary duties of agency. The duty to maintain confidentiality generally survives the termination of a listing agreement into perpetuity. 9.30 a. Performing a comparative market analysis. In preparing a comparative market analysis, licensees should guard against using the terms appraisal and value, which are reserved for the use of certified appraisers. Misuse of these terms could lead to a charge of misrepresenting oneself as an appraiser. 9.31 d. Make a substantial misrepresentation. The license laws of most states list as illegal advertising activities subject to discipline such actions as making any substantial and intentional misrepresentation, making false promises, and making misleading or untruthful statements in any advertising. 9.32 c. Fiduciary. The management agreement creates an agency relationship between the manager and the principal. This is a fiduciary relationship and, in general, the agent is charged with producing the greatest possible net return on the owner's investment while safeguarding the value of the investment for the owner/investor. 9.33 b. Financial reporting to the principal. Financial reporting to the principal is a fundamental responsibility of the property manager. Reports may be required monthly, quarterly, and annually. Required reports typically include operating budget, cash flow, profit and loss, and budget comparison statements. 9.34 d. Revenue from all sources minus losses from uncollected rents, vacancies, and evictions. The total of scheduled rents plus revenues from such sources as vending services, storage charges, late fees, utilities, and contracts is the potential gross income. Subtracting losses caused by uncollected rents, vacancies and evictions gives effective gross income. 9.35 a. Cost per tenant prospect generated per lease. The efficiency of marketing activities can be judged in terms of how many prospects per completed lease they generate. The lower the cost per prospect per lease, the more effective and efficient the program. 9.36 b. Raise rental rates. Vacancy rates are directly related to demand and competitive supply in the market. If vacancy rates in the managed property are too high, the manager may have to lower rates or identify problems in the property or its management that are contributing to vacancy level. On the other hand, if the property's vacancy rate is significantly lower than market rates, the manager may conclude that higher rental rates are called for. 9.37 b. Routine, preventive, and corrective. The foremost maintenance objective is generally to preserve the value of the physical asset for the owner over the long term. Three general types of maintenance are required to keep a property in serviceable condition: routine, day-to-day, preventive, scheduled, and corrective, repairs and replacements. 9.38 a. Ensure that disabled employees have the same level of access to facilities that all employees have. Employers with at least 15 employees must follow non-discriminatory employment and hiring practices and make reasonable accommodations to enable disabled employees to perform essential functions of their jobs. Modifications to the physical components of the building may be necessary to provide the required access to tenants and their customers. Existing barriers must be removed when the removal is readily achievable, that is, when cost is not prohibitive. 9.39 a. Replacement value. The amount of coverage provided by certain types of policies may be based on whether the property is insured at depreciated value or current replacement value. Depreciated value is original value minus the loss in value over time. Current replacement value, which is more expensive, is the amount it would cost to rebuild or replace the property at current rates. Commercial policies include co-insurance clauses requiring the insured to bear a portion of the loss. Fire and hazard policies usually require the coverage to be in an amount equal to at least 80% of the replacement value. 9.40 B. Cash for the management firm's operating expenses. Managers are responsible for proper handling of monies belonging to other parties, trust funds, that come into the manager's hands in the course of doing business. For property managers, such trust funds include rents collected from tenants, security deposits, and capital contributions from the property owner. Funds belonging to the management firm must not be commingled with those of the client. 9.41 C. General property managers are usually considered to be general agents empowered to perform some or all of the ongoing tasks and duties of operating the property, including the authority to enter into contracts. 9.42 B. The tenant pays a fixed rent, and the landlord pays all operating expenses. In a gross lease, the tenant pays an established, fixed rent, and the landlord pays all property operating expenses, such as taxes, insurance, utilities, and other services. This is the arrangement commonly used in residential leases. If the tenant pays some of the operating expenses, the lease is a form of net lease. 9.43 D. The property manager does not have to maintain it. The lease should set forth items that are excluded or included in the leased property. For instance, a residential lease may include built-in appliances such as dishwashers but exclude freestanding ones, such as refrigerators. At issue for the landlord is the cost of maintenance. If a refrigerator is not included, it does not have to be maintained by the property manager. 9.44 B. Deliver a habitable property. The landlord, by way of the property manager, is expected to deliver a property that is habitable. This means keeping heating, plumbing, cooling, and electrical systems in good repair as well as maintaining serviceability of floors, stairways, railings, roofs, and windows. 9.45 C. A tenant declares a landlord in default and vacates the leased premises. A constructive eviction occurs when a tenant vacates the leased premises and declares the lease void, claiming that the landlord's actions have made the premises unfit for the purpose described in the lease. The tenant must prove that it was the landlord's actions that were responsible and may be able to recover damages. 9.46 A. The competitive market for the property. In preparing a management plan, a manager must consider the owner's objectives, including financial goals, the competitive market for the property, both local and regional, depending on the property type, and the features of the particular property. The plan will also include a budget and indications of what the manager intends to do with the property to meet the owner's objectives. National Test 10, Real Estate Math